the best of money matters. Wealth Tracker.
Welcome to the Wealth Tracker, where we dive into the uncharted territories of niche investment strategies that promise to redefine wealth. Hello, I'm Hongbin Jeong. The US dollar is flexing its muscles once again. After months of broad weakening, the greenback has rebounded sharply, gaining ground against the Sing dollar and reversing earlier trends. Now, this turnaround comes amid shifting expectations around US interest rates, signs of resilience in the American economy, and global investors recalibrating risk. But what does a stronger dollar mean for Singapore's markets, the regional investment outlook, and portfolio positioning ahead? Well, to find out more, joining me now is Sim Moh Siong, currency strategist at the Bank of Singapore. Moh Siong, welcome back to the show.
Hi, Hongbin. Thanks for having me.
Thank you so much for joining us once again. Well, Moh Siong, the USD seems to be reversing its downward trend against the Sing dollar since late last month. How much has the USD strengthened against the SGD so far?
So the dollar Sing has hit a low of 127 in early July and rebounded to a high of 130 in early August before settling at about 128 currently. Overall, the Sing dollar has weakened against the US dollar by less than 1% since the start of July. And this ties in with a bigger picture. The US dollar is the best performing G10 currency so far this quarter. But we don't see this as a reversal of the dollar downtrend. This is more like the dollar taking a breather after depreciating by about 7% against the Singapore dollar in the first half of this year.
Okay, then what are the key drivers behind the recent rebound of the US dollar against the Sing dollar?
So the Sell America trade is following the pullback from extreme policy uncertainty. So the reciprocal tariffs were paused pending negotiations, and the U.S.-China tariff war de-escalated. And this helped calm fears over U.S. recession. And the net impact that we saw is that the U.S. equity market has rebounded from a knee-jerk sell-off to above pre-Liberation Day levels. The U.S. dollar remains down, but the greenback decline has taken a breather.
Okay, very interesting. Well then, Moh Siong, is this a reflection of U.S. economic strength, or is it external weakness, particularly in Asia or Europe?
It's a bit of both, I think. The renewed U.S. stock market optimism, especially about AI, has helped the U.S. dollar to stabilize. But the pause in the dollar decline is not just a U.S. story. There are also concerns over slowing growth in the rest of the world, as the trade-related sectors could experience some payback from the tariff-led front-loading.
Okay. Well, then how much of this USD strength is also tied to interest rate differentials and expectations from the Fed?
So I think we have a bit of a structural break here between the relationship between the dollar and the interest rates. The US dollar was depreciating earlier this year, despite the U.S. interest rates differential staying in favor of the greenback. But the U.S. interest rate differentials or U.S. interest rates are starting to matter the U.S. dollar again after undergoing a structural break earlier. And the Fed Chair Powell's message of no rush to ease at the July FOMC meeting kept the U.S. dollar supported. But we'll need to see whether Powell's wait-and-see approach will continue to hold up given the poor July jobs report.
Well, Moh Siong, you mentioned earlier that the USD is not reversing its trend per se, but it is taking a breather at the moment from its downward trend. So does this not signal a shift in USD sentiment? How are investors viewing the USD at the moment?
So I think, the broader backdrop here is that the greenback decline has taken a pause. But this does not necessarily mean that the US dollar is set for a recovery. In our view, we ultimately expect more US dollar weakness as US growth piles up or builds up to prompt a dovish Fed shift. And also, I think more importantly, the structural risks around the US fiscal policy and Fed independence also support our case for the US dollar to weaken against many currencies in the medium term.
Well, in the short term then, is there more room for the USD to grow?
Well, I think there's a bit more room for the USD to take a bit of a breather, but a lot would depend on the data itself as to whether the data showing resilience will continue to hold up in the face of signs of labor market weakness.
Okay. Well, then how might this also shift affect MAS policy, especially with regard to, managing the SGD near band?
So on the policy front for Singapore, following Singapore's better than expected economic growth in the first half of this year, the MAS kept the FX policy on hold in July after easing twice earlier this year in January and April. But we still think that the tariff-driven downside growth risk will keep open the possibility of more easing of the FX policy by the MAS down the road. Having said that, the Singapore dollar remains stubbornly strong against its currency basket, and that's because it's likely benefiting from the safe haven flows given Singapore's AAA credit rating status.
Okay, but how does the strengthening USD interact with, other global macro risks like China's slowdown or geopolitical volatility?
So at a more macro level, I think a stronger dollar will make it harder for emerging market economies to balance between currency stability and lowering interest rates to cushion against a slowing economic growth. But as I said earlier, we see the recent dollar strength more as a short-lived reprieve. There is, however, a case for stronger US dollar rebound if oil prices spike up on renewed geopolitical tension or if China economy slows sharply. But we think the threshold for a stronger dollar rebound is relatively high.
If the USD is just taking a breather here from its downward trend, should investors here in Singapore start rotating portfolios to hedge against further USD strength?
So our view is ultimately for more US dollar weakness, and the recent US dollar strength could therefore provide an opportunity to diversify against an overweight US asset exposure.
Okay, and what else should we look out for in the coming weeks then that could influence FX market movements?
So the next key event for investors would be Chairman Powell's speech at the Fed's Jackson Hole Symposium next week. We are also watching the data now that the tariff drama has simmered down, and the US dollar strength could be cut short by a dovish Fed shift if the US data print comes in soft, especially the next inflation and employment report before the September Fed meeting on the 17th of September.
All right, some great insights from you there. Thank you so much, Moh Siong, for joining me today.
Thank you, Hongbin.
Thank you. That was Sim Moh Siong, currency strategist at the Bank of Singapore. This has been the Wealth Tracker with me, Hongbin Jeong.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.